Welcome to the 15th lesson of Chapter 6, where today we delve into the interplay of leverage and margin in currency trading. We'll start off by defining these two crucial terms, shedding light on their fundamental roles in the world of Forex trading. From there, we'll explore how margin requirements are set by brokers as a percentage of the total trade value, serving as a critical risk management tool. We'll also examine leverage as a double-edged sword, with the potential to amplify both profits and losses. We'll also touch on the concept of a margin call, a protective measure used by brokers to prevent accounts from spiraling into negative balance. Finally, we'll scrutinize trading both with and without leverage, and how these two different scenarios impact your risk exposure and profit potential. So buckle up as we embark on this enlightening journey into the world of Forex. We begin by understanding the fundamental role of margin and leverage in currency trading. Now, imagine you're at a high-stakes poker table. You've got a good hand, and you're ready to go all in. But instead of having to put all your chips on the line, you only need to put down a small deposit. That's your margin. It's like a good faith deposit, a small percentage of your total trade value that you put down to open a trade position. This deposit holds your seat at the table and keeps the game going. But what if you could do more with less? What if you could control a large amount of currency with just a small amount of your own money? Enter the concept of leverage. Leverage is a powerful tool that allows you to control large positions with a small capital outlay. It's like being able to steer a large ship using only a small rudder. It amplifies your buying power, allowing you to make significant profits from small price movements. However, it's essential to remember that just as leverage can multiply your profits, it can equally multiply your losses. If the market moves against your position, you could lose more than your initial deposit. That's why it's crucial to manage your risk effectively when using leverage. So let's recap. Margin is the deposit you make to open a trade position, and it acts as collateral for the borrowed money you use to make a trade. Leverage, on the other hand, is the tool that lets you control large amounts of currency with a small capital outlay. It magnifies both your potential profits and potential losses. Together, margin and leverage form a critical part of Forex trading. They allow traders to participate in markets where the value of trades is significantly higher than the capital they have at their disposal. It's like being given the keys to a high-performance sports car. But remember, with great power comes great responsibility. Remember, understanding these concepts is key to navigating the Forex market. Now let's explore how margin requirements are set and how they serve as a risk management tool. Margin is like a good faith deposit, a chunk of your capital that you set aside to open and maintain a trading position. But how is this margin requirement determined? Well, it's actually set as a percentage of the total trade value by your broker. It's like a safety net, ensuring that you have enough funds to cover any potential losses from the trade. Think of it as buying a house. You don't pay the full price up front, right? You pay a down payment, which is a fraction of the total cost. That's your margin. And the rest of the money, that's where leverage comes in, but we'll tackle that in another scene. Now, you might wonder why brokers set margin as a percentage of the total trade value. Well, it's all about risk management. By setting a margin requirement, brokers ensure that traders have a stake in the trade. It discourages reckless trading and encourages traders to think carefully about their decisions. It's a way to keep the market stable and protect both the trader and the broker from excessive losses. You see, trading is not just about making profits, it's also about managing risks. And margin requirements play a crucial role in that. They serve as a buffer against market volatility and unexpected price movements. They keep your trading account in check and prevent it from falling into a negative balance. But remember, while margin requirements provide a safety net, they do not eliminate the risk of losses. It's still up to you, the trader, to manage your trades wisely. Always keep an eye on your margin level and make sure it's within a level that you're comfortable with. And most importantly, never risk more than you can afford to lose. Thus, margin requirements are crucial to maintaining a balanced trading strategy. With a deep understanding of how margin works, you're one step closer to managing risks efficiently and achieving your trading goals. Leverage, though beneficial, can also be a double-edged sword. Right off the bat, it's important to bear in mind that leverage is a powerful tool, one that can amplify your potential profits. But like any tool, it needs to be handled with care. Imagine leverage as a magnifying glass. Just as a magnifying glass can intensify the sun's rays, leverage intensifies the power of your trading capital. This means that even a small market movement can lead to substantial profits. But here's the catch. The same magnifying glass can also burn you if you're not careful. That's right. Just as leverage can increase your profits, it can also amplify your losses. Let's illustrate this with a simple example. Suppose you have $100 in your trading account and you decide to trade without leverage. If the market moves in your favor by 1%, you gain $1. Not bad, right? But what if you had used a leverage of 1 to 10? That 1% market movement would have turned your $1 profit into a $10 profit. That's the power of leverage. But wait, remember the double-edged sword? Now let's say the market moves against you by 1%. Without leverage, you lose just $1. But with a leverage of 1 to 10, that same 1% market movement could result in a $10 loss. Ouch, that stings. So you see, while leverage can amplify your profits, it can also increase your losses. This is why it's crucial to use leverage carefully. It's not about avoiding leverage entirely, but about understanding its potential effects and managing it wisely. If used correctly, leverage can be a trader's best friend. But if used recklessly, it can lead to significant losses. So always remember to use leverage wisely to maximize profits and minimize losses. The key is to strike a balance, to harness the power of leverage while also keeping the risks in check. As with all things in trading and in life, it's all about balance. Margin calls serve as safety mechanisms in Forex trading. Now let's unpack that a little. Imagine you're on a roller coaster ride and margin calls are your safety harnesses. They're there to ensure you don't tumble into the abyss of negative balance. But what exactly is a margin call? It's essentially a broker's way of saying, hey, your account balance isn't sufficient to cover potential losses. It's a warning signal, a red flag that your open positions are at risk. And just as you'd fasten your seatbelt when the plane's fasten seatbelt sign lights up, you need to act when a margin call is issued. So how does it work? Let's say you're in a position that's not going in your favor. As your losses increase, your available margin decreases. When your margin level hits a certain threshold, usually around 100%, you're in the danger zone. That's when a margin call is triggered. But here's the important bit. A margin call isn't just a warning, it's a call to action. It's a cue for you to either deposit more funds into your account or close some positions to free up margin. If you don't act, your broker has the right to close your positions on your behalf. This is to prevent your account from falling into a negative balance and to protect both you and your broker from further losses. To put it simply, margin calls are a protective measure, a safety net designed to prevent your account from falling into negative balance. They're not something to be feared, but rather understood and respected. And one more thing, remember, you can avoid margin calls by managing your risk wisely. Use leverage judiciously, keep an eye on your margin levels, and always have a risk management strategy in place. Therefore, understanding margin calls can save you from potential financial pitfalls. It's like knowing how to use your safety harness before the roller coaster ride begins. It's all part of the exciting world of Forex trading, so buckle up and enjoy the ride. Having understood the basics, let's explore scenarios of trading with full capital investment and with leveraged capital. In the world of Forex trading, you'll often hear the term leverage. Leverage is essentially borrowed money from your broker to increase your buying power in the market. This allows you to control larger positions with a smaller capital outlay. It's like a loan that increases your purchasing power, but also your exposure to risk. Imagine, for instance, you're trading without leverage, with a full capital investment. You have $1,000 and you decide to buy euros at a rate of $1 per euro. You get 1,000 euros. If the rate goes up by 1%, you make a profit of $10. Your risk is limited, as is your potential profit. Now let's consider the same scenario, but this time you're trading with leverage. Your broker offers you a leverage ratio of 100 to 1. This means that for every dollar you have, you can control $100 worth of currency. So, with your $1,000, you can control $100,000 worth of euros. If the rate goes up by 1%, your profit is $1,000. That's 100 times more than if you were trading without leverage. But here's the catch. While leverage can amplify your profits, it can also magnify your losses. If the rate goes down by 1%, you'd lose $1,000. That's your entire initial investment. So, leverage is indeed a double-edged sword. It can give you the potential for higher profits, but it also exposes you to higher risks. On the flip side, trading without leverage offers a lower risk profile. Your losses, like your profits, are limited to your initial investment. You might not make as much profit, but you're also less likely to lose your shirt if the market moves against you. In essence, trading with full capital investment provides a safety net. You know exactly how much you stand to lose, and your potential profits, while smaller, are more predictable. On the other hand, trading with leverage is like walking a high wire. The potential for higher profits is there, but so is the risk of larger losses. It's a balancing act, requiring careful management of your funds and a deep understanding of market conditions. In both scenarios, it's crucial to have a solid risk management strategy in place. Whether you're trading with or without leverage, you need to know when to cut your losses and when to take your profits. This should give you a clearer picture of the risks and rewards of both types of trading. Remember, the key to successful trading lies not just in understanding these concepts, but in applying them wisely. After all, in Forex trading, knowledge is power, but wisdom is profit. Finally, we'll look at how margin and leverage ratios affect your trading capacity and risk exposure. Margin and leverage ratios are like the gears of your trading vehicle. They determine how fast you can go and how much control you have over your ride. Let's delve deeper into these essential tools of the trade. Margin ratio is typically expressed as a percentage. It represents the portion of your own money that you need to put down to open a position. Consider it as your skin in the game. For instance, a margin ratio of 1% means you're using 1% of your own money and borrowing the rest from your broker to control a larger position. On the other hand, leverage ratio tells you how much of a position you can control with a given amount of your own money. If your broker offers a leverage ratio of 100 to 1, that means with just $1, you can control positions worth $100. Now, why do these ratios matter? Well, the margin ratio is essentially a measure of risk. A higher margin ratio means you're risking more of your own money. It makes your potential losses higher, but also your potential gains. On the flip side, a lower margin ratio means you're borrowing more, which can amplify your profits, but also your losses. Similarly, a higher leverage ratio can magnify your gains, but remember, it can also magnify your losses. It's like using a more powerful engine in your trading vehicle. It can get you to your destination faster, but it can also make you crash if you're not careful. These ratios are not just numbers. They're crucial strategic tools that can shape your trading journey. They're your compass and speedometer, helping you navigate the volatile sea of Forex trading. Remember, there's no one-size-fits-all strategy in trading. The right margin and leverage ratios for you depend on your risk tolerance, investment goals, and trading style. Understanding these ratios is key to developing a successful trading strategy. So, use them wisely to steer your trading journey towards success. And with that, we conclude our 15th lesson of Chapter 6. We've traversed the dynamic landscape of margin and leverage in Forex trading, understanding their fundamental roles and implications on trading strategies. We've looked at how margin serves as a deposit for trade positions and as a risk management tool, while leverage aids in controlling large positions with a small capital outlay. We've also explored leverage's dual nature, amplifying potential profits and losses alike. We understood the protective role of margin calls and the differing scenarios of trading with and without leverage. The importance of margin and leverage ratios in making informed trading decisions and managing risk was also highlighted. As we wrap up this lesson, remember that the interplay of leverage and margin is central to your trading journey. It's essential to manage them carefully to navigate the volatile seas of Forex trading successfully. I encourage you to complete this lesson and look forward to seeing you in our next lesson, Forex Margin Trading Glossary and Quick Reference Guide.